Hi, everyone. This is Jeff Praissman with IBKR Podcast. It's my pleasure to welcome back to the podcast studio Market Chameleon's Dmitry Pargamanik and Will McBride. Hey, guys, how are you?
Hey, Jeff, thanks for having us.
Hey, Jeff, a pleasure always.
Oh, yeah, it's always great to have you guys come in after you do your monthly webinar and do I don't know about deeper, but definitely a different dive on the subject matter. We just finished up a great webinar on straddles. And I think we should probably just for our listeners, guys, if it's all right, start with the basics, the fundamentals. Could you explain to our listeners what exactly a straddle is and why it's a particularly unique kind of strategy compared to some directional optional strategies that many retail traders might be more familiar with?
Yep. Thanks, Jeff. Yeah, the straddle itself, it's a strategy that involves two options. And we think of a call option, we think of a direction expression of a stock going up, right? So if you're buying a call option, you're looking at a directional type of trade. Put option is a trade that looks at downside or bearish direction. But when we look at a straddle, when we do both, a straddle is considered a typical straddle. It's an at the money. So you're looking at strikes that are very close to where the stock price is. And if you do a combination as a strategy, let's say buying a call or buying a put, then you're not looking at a directional bias, but really a buy, or you're looking for a movement, because if the stock goes up, let's say in the situation you're buying a straddle, if the stock goes up, your call will gain in value, your put will lose in value. So it needs to move up enough to cover the cost of both those options at expiration, or it could move down and your put will increase, your call will decrease. So the stock has to move in that direction by enough to cover the costs of both options. Your call might be worthless and you lose everything on the call, but if your put gains in value to offset that loss and more, then, that strategy will then pay off. So again, when we combine those options, then we take out the directional aspect and we're now looking at the magnitude.
Volatility trading really seems to be the hard to straddle strategies. How should traders differentiate between situations that call for betting on volatility expansion versus contraction? And are there market signals that typically indicate a potential volatility mispricing?
Yeah, those are good. There's two questions in there. And for volatility expansion, we're looking at a situation where our outlook is that volatility will increase. In that case, you do want to buy the straddle if you think that the straddle, the implied volatility in that straddle, it is below where your expectations of volatility. And there are two ways actually for a straddle trade to trade it. One is you just buy the straddle and you're hoping for a move that would offset the cost of that straddle, large enough move. Or if you think that the volatility itself will increase from day to day, then you could trade the Black-Scholes model where you're hedging your deltas on a daily basis and you're trying to offset the trading in the underlying versus the decay in the stock. There are two ways to approach that trade. And of course, if you're looking at maybe the other way where you think the implied volatility looks like it's above where my expectations of the forward-looking volatility in stock, then you would be a seller at that strike because you think that the premium that's priced into those options are too high relative to where you think this stock will move. For volatility mispricing, part of it is we don't know what the future volatility will be. Obviously, that will make things much easier, but we do, as traders, we try to model or use certain metrics to try to estimate what we think the future volatility will be. Create your own estimate or forecast, and that's where the models come in. And by using your estimates versus where the markets are, which you can observe, that's where kind of you try to determine if they're mispriced, if they're much higher or lower based on your estimates that you do put in your unique outlook and factors.
And there's thousands of stocks. And in this day and age, hundreds of data points. So when you're screening across this vast universe, what would you consider your top 3 filtering criteria to quickly narrow down the search of
Yeah.
the most promising straddle candidates?
Yeah. Usually when I perform a screen, I have some kind of thesis or something that I'm looking for. And based on that's where I'll use the filter. So if I'm looking for, maybe my thesis is I'm looking for earnings situations, and maybe that this earnings will be particularly volatile, I'll start screening out options that cover earnings. I'm going to compare those to the estimates versus my estimates. So a lot of the screen will really depend on what your initial thesis or what you're trying to look for. But typically, I think that there are some things that I do look in common. One is I'll take a look at the liquidity of the options, or look at how much trading is going on around those at the money options. This will give me an idea of the volume, trading activity, and trading interest, because if I could take that and analyze it, price discoveries is a little bit easier. The spread of the markets, something that sometimes you'd want to look at or filter in. There are things maybe to look for, maybe other things that might impact the straddle of upcoming events. But so there are certain things maybe that you tend to use in all the filters, such as liquidity and pricing, and then other filters just depending on what you're trying to find at that moment.
And we already talked about, obviously, like volatility is a big effect on straddles, and one of the reasons you would use them. And event-driven trading and straddles are really popular, especially around earnings announcements. And earnings announcements are pretty consistent, right? It's every quarter, companies are going to announce earnings, that's an event. But there's other events as well that these straddles could be potentially used for. Could you talk about what some of these other events could be, and then also what sort of catalysts tend to affect the volatility patterns, both like before and after the event?
Yeah, no, that's good. The options, one of the things that will impact the volatility are those events, like you mentioned, earnings. Once a quarter, company will report earnings, and we know that on an earnings announcement, the stock has the potential to make a much bigger move than on a typical day, because now you have some news that's material to the stock price. But that's not the only event that companies may move on. We have certain events like companies hold investor relations meetings, annual meetings. They'll have sometimes industry conferences where they might announce something about a product, or management might give a forward-looking statement. We have healthcare stocks that have many different periods where they might release studies, or you have the PDUFA meetings, FDA. All those are material, large potential catalyst events. And sometimes just economic events could move stocks, where the Fed announces interest rate policies, FOMC meetings. We could get surprise inflationary numbers. Those themselves can impact the market, move the market, and stocks will move in sympathy with it. So something to be aware of in your option pricing models or in your estimates, because a lot of these events, some of them are surprises, but a lot of these events are telecast ahead of time. Earnings and conferences, investor meetings, economic releases, you could get a schedule of those upcoming events. So this way you could prepare appropriately.
And that kind of leads me into my next question, and from 2 different angles, right? So the concept of implied volatility versus historic volatility and the percent changes, right? So there's obviously, first, I guess one of kind of 2 questions. First of all, is there a range you kind of look at, whether you consider going long or short to straddle the implied volatility versus the historic volatility? But then I would even flip that question. And sometimes you had just talked about, we all know earnings events, right? And we all know these ones that are scheduled, but you actually just mentioned these surprise events. I would assume that there's sometimes where like the market is telling us they're expecting something when there's really no news out, but like the volatility pricing is like warning you, like, hey, hold on a second, these May 50 straddles look a lot higher than they should be right now. Maybe there's something coming out that we don't know about.
Yeah, exactly. One of the ways the market is helpful is the insights that you could gain from just observing where markets are pricing forward-looking volatility. And that's a great question, because if we look from stock to stock, stocks move at different volatilities and they all have different implied vols. SPY has an implied volatility and Apple has its own volatility and so forth. So to be able to determine, well, is the implied volatility on the high end or low end of the range, we'd have to compare it to that particular underlying historical implied vol. So if Apple was at a 30 vol, for example, we could take a look at it historically. If the range is from 25 to 50 and this amount of percent of the time it's below this or about this point, we could figure out, okay, then the markets are pricing it on the low end or the high end. And that could be important because let's say the markets are, as you mentioned, they're pricing it on the high end, but you don't really know why or can't find the reason. The markets could be telecasting something. You would think, okay, if there's an earnings, that makes sense. Maybe if there's like a upcoming conference with some announcement, then it would make sense. But there are times where it seems like it's priced on the high end, or maybe the other way, but you don't really understand what's causing it, right? I don't see the things that I would look for typically that would cause this. You're not sure. So now the market might be telling you something, right? To dig in deeper, they might be telling you, hey, somewhere out there, people are expressing an opinion that there's more volatility, less liquidity coming in or underlying. And that's a heads up, a warning for traders. So yeah, there are ways to look at markets for finding potential opportunities, but also what are they signaling, about forward-looking volatility.
And that also obviously leading to that, like break-even points are obviously super critical for straddle profitability, whether you're long and you want to go past the break-even point and have them profitable in either upward or downward move, or you're shorted and you don't want to go past that break-even point and you want it to stay right there. And leads, kind of leads me into, let's just talk about short straddles for a second. They offer pretty attractive premium. They come with theoretically unlimited risk, right? Especially on the upside. I guess the downside, the stock could go to zero. So you're stopped out. If it's a $50 stock, you're going to lose $50 minus the premium if it goes to zero. But on the upside, it could go on forever how much you lose. What specific risk management techniques and position guidelines, would you recommend for traders exploring short straddle strategies?
Yeah, that's also a great question, because when we look at a long straddle, we know ahead of time what our risk is. It's what we paid for, right? So it's like if you bought a straddle if you bought a put for $5 and a call for $5, your risk is $10 that you paid for that straddle if it goes to zero. But on a short side, what you could potentially gain, right? It's that premium that you collected. But you don't know what you're risking for that premium, right? Like you would have to estimate it, because nobody, unless you buy wings out there to stop you out, you're just short the straddle. You don't really know what that risk is. How do you manage that risk is the question. Is the risk I'm taking worth the potential? Is the reward I'm trying to make, right, from selling it, worth the potential risk that I'm taking? That risk needs to get estimated. And there's no right way to do it, because now you're running an estimate. So you have to create a model. And a quick way to estimate is you could shock the stock based on, historical outsized moves. Let's say, what is the largest move this stock ever did? 25%. What if it did that now? Right? Because obviously you could say if the stock goes to zero, but that really doesn't happen that much. So maybe not go to zero, but what is an outsized move in this typical stock?
Right.
So you could shock it.
like a realistic outlier move. Or maybe not realistic is the right word, but like a 3-4 standard deviation.
Yeah, exactly.
Real worst case scenario that could actually probably could happen versus this, like you said, the
Yeah,
stock's not going to go to zero, but it might have dropped 25% a few different times over its life. And again, you don't think it's going to happen, but it could. Like,
exactly. Exactly. So you'd want to see, what am I risking in that scenario?
Mhm.
What am I risking exactly if it moves 1 standard deviation, 2 standard deviations, 3 standard deviations? Where does, where do I have to buy back that straddle versus what I've sold it for? So if I sold the straddle for $10 and then let's say, I don't know, 2 standard deviation move, buying it back for 20, really then I'm looking at a risk of, if you're buying it back for 20, you're losing $10, right? Because you bought it for 20, sold it for 10. So you're losing $10 to potentially make $10 in the best case scenario where it goes to zero. So there you do have to now run model, shock the stock, given it like some kind of estimate based on data or like a historical data, or like you said, you could just create your own shock and say 20% move. That, I think that's the worst case. And then compare, all right, this is where, if at that point, this is what I'm buying back the straddle for. This is going to be a loss of X. What do I think I have to gain if it stays within 1 standard deviation, this much? And then you create a risk reward analysis that way.
And time decay plays a big part in straddles. It works against long straddles, but certainly benefits short straddles. How do traders balance the trade-off when looking at the time horizon, whether to, if they have enough time for the move to materialize, if they're long a straddle, versus minimizing their exposure if they're short the straddle and hoping that it goes out prior to busting through those break-even points if you're short, and hoping they have enough time to have it move past those break-even points if they're long.
Yeah. No, that's an important question where you're looking at a straddle, and we know that the straddle itself eventually is going to expire, has an expiration date. So you don't have it forever. And with options, what we do is we have decay. That means as you get closer to expiration, they're worth less because of time decay. You have less time for it to go into money. And time decay is something where it's also not constant or linear. I guess that as you're getting closer to expiration, it starts to decay faster. Okay, that's just how options work. So if we look at our theta, 30 days to go, your theta might be losing, let's say 10 cents per day in time decay. Nothing happens, all right? But as you get closer, it might increase to 15 cents. Then so it does, the time decay on a relative basis, relative to the option value, actually, it's not linear. And that's something also to keep in mind when you're looking at an option. And if you're looking, well, I think between this and this date, I think the volatility is going to be X. You have to take that into consideration in your overall analysis. So it's tricky, right? That's part of trading. There's no right answer, but the closer you also get to expiration, the option is worth less. It decays faster. It's worth less, meaning that a bigger move will make that option go into the money faster, right? So there's a trade-off with that. And you're absolutely right. That time decay to balance, it's, as a trader, you'd really have to model your outlook for that time period where you think the stock will move. But besides time decay, you might be in a situation where you know that the option, let's say, is straddle worth X amount, even if it has maybe 10 days to go, or looking around into earnings, once that earnings event passes, let's say it's tomorrow, if nothing happens, the value will drop significantly.
That vol will drop after that event.
That vol will drop because it was priced in an event.
Mhm.
Even when you're looking at the theta of the options, the theta to decay, there are other factors in there that you have to consider.
True.
That high volatility can itself drop significantly or go up significantly from here. So the theta gives us an indicator of what, if nothing else happens, the implied volatility doesn't move, there's no movement, shock to the stock, how much will these options lose value in one day? So we could compare those estimates, but other factors need to be considered, just like we discussed, like earnings and so.
And, we discussed a lot of quantitative factors today, Will and Dmitry, but are there qualitative factors that you consider as well before entering a straddle position? I guess besides the events.
Like the events will be one of them off the top of my head. Or one thing when we look at options, like the option pricing model, right?
Mm-hmm.
The Black-Scholes assumes that the stock is gonna move at some average volatility, right, between now and expiration. That's what it assumes. But the situations aren't always like that. With, for example, if the stock is a takeover candidate, and let's say the price of the stock is 95, the takeover price is 100. So based on that, we're looking at a different situation, right? We're not looking at daily volatility anymore. Now you're looking at the probability of the deal going through or breaking apart. Because if it goes through, you're looking at $100, right? So you're not looking at volatility where it's going to move at, based on historical volatility, it's just going to get taken over, and then it goes, and then those options disappear, right? The stock's not going to 120. It's not going to 130. It's down, taken over. Maybe the deal breaks apart, then the stock might fall back to where it was. So when you're looking at that situation, well, you're taking out the volatility component. You're not pricing an option anymore based on the estimated volatility, daily movements. You're pricing in if the deal will be successful, go through or not. The same thing could be also for, let's say, a biotech company, where a biotech company is waiting for some approval. Let's say, if the stock is, let's say, $10, and you think if it gets approved, it's going to 30. If it doesn't, it's going to $1. You're now looking at daily volatility. The Black-Scholes model doesn't work in that situation. Now you're modeling the probabilities of an event, the probability of it getting approved and where you think the stock will move to based on approval, or if it doesn't get approved or something bad happens, where does the price move to and what's the probability of that? So now you're pricing in a straddle based on completely different, not a historical volatility of the stock, right? You're not looking anymore, how does the stock move around? Now you're looking at, based on these circumstances, where do I think the stock will move to after this particular event? Yeah, there are situations like that exist, and you have to take that into consideration and price your options different.
Will and Dmitry, this has been great. Thanks again for coming by our studio. And for our listeners, you can catch Will and Dmitry Monday through Friday on their YouTube channel show right before the market opens. And also on our website under education, you can catch their past webinars and past podcasts. Thanks again, guys. Looking forward to the next time.
Thanks,
Great
Jeff.
job, Dmitry. Thanks, Jeff.
Yep.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances and, as necessary, seek professional advice. Options involve risk and are not suitable for all investors. For information on the uses and risks of options, you can obtain a copy of the Options Clearing Corporation Risk Disclosure document titled Characteristics and Risks of Standardized Options by going to the following link: ibkr.com/OCC. Multiple leg strategies, including spreads, will incur multiple transaction costs.